Good morning, everyone. Thank you for joining us here at the Singapore Pavilion. Next up, we have a program by Temasek on the case for transition planning, finance mobilization, and policy execution. This program covers how public and private leadership and collaboration can accelerate climate transition planning. Without further ado, let me invite up Mr. Alvin Low, Director Ecosperity and Macro Strategy, Temasek, for welcome remarks.
Well, let's get started. Hi, everyone. Good morning. I'm Alvin from Temasek. Super stoked to be here in Belém. When I told my team I was speaking on transition planning, or this panel was on transition planning, they asked if that meant changing my flights or changing the world. I said hopefully both, but let's start with the world first. So welcome to Ecosperity Conversations at COP30. I'm in partnership with the International Transition Plan Network. We're delighted to have you with us. So I lead Ecosperity, which is Temasek's sustainability, thought leadership, and advocacy platform. Today, we'll explore the case for transition planning, finance mobilization, and policy execution. The aim is simple: to move from commitments to credible action. And together with our distinguished panel, we'll discuss how finance and policy can work hand in hand to make that happen. Now, but before we dive into the panel, a very quick word about Temasek and Ecosperity. So Temasek was founded in 1974 with an initial portfolio value of $350 million. Today, that very portfolio stands at $434 billion, expanded 1,200 times, implies a 14% CAGR since inception. We are wholly owned by the Singapore government, but we operate independently and commercially across 13 offices in 9 countries. So sustainability is at the core of everything we do, especially of how we invest. We don't view it as a trade-off, but very much a foundation for long-term value creation. And as a intergenerational investor, we always invest with tomorrow in mind. And I think our purpose statements capture this best, which is so every generation prospers. But how do we make sustainability tangible and real at Temasek? Our sustainability strategy rests on 3 key tenets and 5 key levers. The 3 tenets are to have net zero portfolio emissions by 2050, to be nature positive, and to always seek for inclusive growth. To action that, we have 5 key levers. The first is investing in sustainability. We put our money where our mouth is. So we have over $46 billion worth of investments that are deployed into sustainable living trend-aligned investments. In terms of investment evaluation, we have integrated ESG principles fully across the life cycle, going across from pre-deal diligence to all the way to post-deal engagement. We have also implemented an internal carbon price that started in 2021 at $42 US. It's now $65 US, and we will expect it to rise to $100 US by 2030. In terms of portfolio engagement, we work very closely with our portfolio companies. We rely on 2 frameworks, one of which is the Climate Transition Readiness Framework, and the second of which is our ESG Value Creation Playbook. Then I think in terms of internal institutional sustainability, we lead by example. We have achieved a 28% reduction in average carbon intensity per employee compared to pre-COVID levels. And last but not least, we believe in collaboration. We partner with peers, policymakers, and networks to mobilize capital and drive scalable solutions. But the proof is in the pudding. We need to walk the talk. And so here are some of our key climate actions, ranging from green investments to decarbonizing industries. But we believe that the real power lies in partnerships, the catalysts that make transformation possible, which is a nice segue to Ecosperity. So Ecosperity started very small. It began a little over a decade ago in 2014. It was a half-day internal session that had fewer than 100 people. Today, it's a global platform that connects investors, innovators, and change makers, really turning sustainability ideas into action. So for this year's edition, our flagship event, which is Ecosperity Week in May, is a leading sustainability gathering and continues to go from strength to strength. This year, we have more than 4,000 participants, so we've gone over 40 times since 2014. 3/4 of which participants are senior leaders in their respective fields. and 1/3 are international delegates. So more than 1 in 3 actually come from overseas. Now, to be clear, we're not aiming for the numbers. We're very much for the quality of the content and the networks. So it's very much a dynamic mix of ideas, energy, and collaboration. It's also very focused on turning ambition into implementation. This serves us well because we are action-oriented and we believe in outcomes. So before I close, a very quick shameless plug. Ecosperity Week will happen in 2026 next year, from 18 May to 21st May in Singapore. The theme for next year will be Asia's Race Towards 2030, powered by innovation and driven with intent. We hope to see you there. And if it's your first time in Singapore, don't worry, the only thing warmer than the weather will be the conversation. We will also endeavor to make you sweat less, and we rest assured we'll be powered by sustainable cooling technology. To conclude, Temasek has come a long way since its inception in 1974. It's grown at 14% CAGR, as mentioned, to reach $434 billion today. We are an intergenerational investor. Sustainability sits at the core of everything we do, so that every generation prospers. Our sustainability strategy is built around 3 tenets and 5 levers, driving progress towards net zero, nature positive, and inclusive growth. We recognize that we cannot do this alone, so Ecosperity is our platform to convene ideas, partnerships, and action. And with that, I'm delighted to hand over the reins to Dr. Arunabha Ghosh. Dr. Ghosh, please.
Good morning, bon dia. Thank you to Temasek and Ecosperity for inviting me. I can add to Alvin's plug. I have been to Ecosperity now, I think, 3 years in a row, and I definitely look forward to those conversations. They're much more action-oriented than you would normally get in a negotiation like a COP process. So let me also add my 2 bits to welcome you to Ecosperity next year. In my opening remarks, I wanted to focus on why this transition planning is important, but also a little bit about how the role of corporates and the role of policymakers can converge to make this process a little bit more easy than if we were to do it alone. I served 3 years ago on the UN Secretary General's high-level expert group on net zero commitments of non-state actors. And in that report, Integrity Matters, we laid out some very clear recommendations for corporates to establish credible transition plans with near-term targets, eliminating fossil fuels, aligning their governance with their climate goals, aligning their lobbying and advocacy in line with their stated commitments, and of course, bringing in climate risk assessments into corporate planning and into corporate governance. Now, all that is good. How do you actually get it done? And I want to offer 4 different sort of building blocks to making it happen. The first is disclosure. There is no question that we have a large number of disclosure requirements. If you are one of those unfortunate souls in the corporation responsible for that, it's a more than 24/7 job, and our commiserations to you. Nevertheless, disclosure matters because it separates the wheat from the chaff. It avoids that adverse selection problem and allows for investors and shareholders and consumers to decide who's on track and who's not. But disclosures also helped with more clear policies and frameworks and regulatory frameworks from governments. In India, the country I come from, there have been a series of new frameworks that have been put forward, both by the central bank, but also by the Securities and Exchange Board, particularly on what are called the business responsibility and sustainability regulations. In fact, just a couple of weeks ago, my organizations and the Indian Institute of Corporate Affairs, we released a report finding that of the top 1,000 companies in India, most are now credibly disclosing on scope 1 and 2. Scope 3 is everyone's holy grail, but at least it is a start. But there are other regulations that are needed from the insurance sector, the insurance regulators, the pensions regulators, and so forth. But this is critical, and it's important that at least large institutional investors like Temasek and large corporations work with the regulators to find that alignment. The second building block is finding economic value in the transition. I think a lot of struggles that we've had with regards to the transition is that the benefits have been diffuse and the costs have been concentrated. And as a result, you get the political economy pushback, which slows down and decelerates the transition. Can we flip the script? Can we focus on more concentrated benefits for those who are leading the charge and more diffuse costs? Now, for that, you need the policy framework to set the long-term national targets, whether it's for net zero, or sectoral targets, whether it's for hard-to-abate sectors or clean energy and so forth. But it also matters if we then create a carbon pricing mechanism on a domestic carbon market. It sends the signal that the policymakers are interested in concentrating the benefits. However, this then links to the corporate actions or the actions of the first movers, the third building block, the sustainability policies and programs within the corporates that want to distinguish their product and services offerings. We see this significantly in India now. Many of the large corporations are moving beyond just sustainability reporting to aligning their targets with the science-based frameworks, towards developing their internal decarbonization plans, and then aligning it with the ISSSB. But it's also important to embed the value chain emissions disclosures into how the long value chains that we have can start taking some of the lead in the transition. It can start with simple electrification of a lot of the processes, and then towards the heavy or the high-intensity heat processes that the hard-to-abate sectors are involved with. A key mechanism here is that we see that some corporates are certainly using their transition plans and their climate-aligned plans to raise new capital. For instance, India's cement producer, the Ultratech Cement, has raised nearly $900 million in sustainability-linked financing, including a $400 million sustainability-linked bond, because it had started putting those climate plans in place. And then finally, we need to create the frameworks and the ecosystem that enables corporations to invest for the long term. Otherwise, from a quarter-to-quarter reporting framework, it is going to be hard to tap into the public capital markets. So how do we deepen the debt capital markets? And that requires a lot more work, especially in emerging economies, to develop, as India has done, a sovereign green bond framework, or to create new credit enhancement mechanisms, especially for green bonds, or even tapping into the opportunity for municipal level green bond disclosures. I think we need to bring these different elements together and not just leave it to governments alone to declare a target, and not just leave it on the shoulders of corporations and their boards to take that responsibility forward. The 4 pillars I've outlined for you, from disclosure to policy setting in the long term, to focusing on economic value and investing in the long term, can bring corporations and policymakers together and ease this process of transition planning, and yet open up the opportunity for new investment, new innovation, and new corporate leadership. Thank you.
Okay, well, hello everyone. My name is Ben Caldecott. I chair something called the International Transition Plan Network. I also co-headed this the Secretariat for the Transition Plan Task Force, which merged into the ISSB last year. So it's a pleasure to be here. Thank you to Temasek and to Singapore for hosting this, and also to echo what Alvin and Arunabha said before about Ecosperity. It sort of mirrors, it's a microcosm of the journey I think that Singapore has taken. It's very rapidly become this global platform, and I thoroughly encourage you to attend if you can go. So what I'm going to do, I've got two jobs today. The first is to give a very short presentation about two reports that have come out recently from ITPN, the International Transition Plan Network. And then I'm going to be moderating a panel discussion with some very distinguished speakers where we're going to talk more about transition plans, transition finance, how the public sector can work with the private sector on those topics as well. So let me first tell you a bit about these two reports. So these came out last week. The first report, Private Sector Transition Plans, a critical tool for mobilizing finance, is a summary of the relationship between transition plans and transition finance designed for public sector officials. And hopefully there are people working in the public sector working on policy here today. It sets out the key areas where, as a result of private sector transition planning, finance is already flowing. The report also includes a set of case studies that demonstrate where transition plans have already been used to mobilize transition finance in practice. So I commend those case studies to you. They give you some good international examples of how this is working. The second report that came out was a discussion paper on sector transition plans, a bridge between national ambition and company transition plans. And this was co-authored with the TPI Centre for Global Transition at the London School of Economics. And this discussion paper explores the emerging topic of sector transition plans as a tool to link national ambition with company transition planning and company transition planning processes. And it focuses on three contributions these plans can make for policymakers, companies, and financial institutions. And I'll say a tiny bit more about that in a second. And both of these papers were based on extensive engagement internationally, led by ITPN across its global network of 40 public sector organizations across 25 different jurisdictions. So this reflects emerging best practice internationally. Okay, so how can transition plans mobilize finance for climate objectives? The report from ITPN identifies 5 key mechanisms. The first is by enhancing market confidence, by providing a means to assess the credibility of commitments and the feasibility of actions that are planned by preparers. And these can reduce the risk of actual and perceived greenwashing and legal liabilities. And you'll see in the report that there are there's emerging case law and opinions, legal opinions in relation to how transition plans can reduce litigation risk for companies. The second route is through managing risk by helping financial institutions, companies, and regulators to identify and price forward-looking risks. And this can reduce uncertainty, increase resilience, and support financial market stability. A survey of 37 global banks and insurers showed that 93% are either using client transition plans in risk management, due diligence, and stress testing, or are planning to do so. In addition, transition plans can be used in microprudential regulation as well to manage financial risks and improve and enhance the stability of the financial system. And that's one of the reasons why central banks and supervisors, including through the Central Banks and Supervisors Network for Greening the Financial System, the NGFS, have been working on transition plans. The third route is by identifying investment opportunities, by assessing transition plan information when making decisions about products, portfolio construction, and capital allocation. So, for example, a survey conducted by Pollination, which is an advisory firm, showed that 85% of banks and investors that were surveyed are using transition plans to assess growth opportunities for their clients. So information from transition plans enables financial institutions to systematically identify activities and companies with strategies to grow, and that creates commercial opportunity. The fourth route is by driving value creation and competitive advantage through the implementation of credible transition plans. So transition planning can drive improved managerial capacity, improve relations with investors, improve competitiveness. Another data point, a Lloyds Bank survey found that 65% of UK corporates stated that achieving transition plan goals will make their company more competitive. And this speaks to the fact that transition plans need to be part of, an integral part of corporate strategy, and that's how it's framed in ISSB S2 and in the related guidance from the ISSB. And then finally, by influencing access to capital and financing costs. And this is the evidence base for this is developing. It's still early days. Initial research from my group at the University of Oxford shows that energy and utility firms with higher levels of transition plan disclosures have seen lower debt financing costs. Emerging evidence, again, more to do with caveats. But you also have another data point, MSCI research showing that high emissions firms who are on track to meet their emission goals are rewarded with lower spreads, and firms who don't are being penalized in capital markets. So there is mounting evidence that markets are distinguishing between credible transition plans and those that are non-credible or off track. So I mentioned this other paper, the one on sector transition plans. At ITPN, we're often asked how to create an enabling environment that supports private sector transition planning and transition finance. One area that's very important, we think, is sector transition plans. And these set out a sector's emissions pathway, its technology roadmap, and its financing requirements. And these can help policymakers to communicate the direction of the transition in the jurisdiction that they're responsible for. It can help to provide clear signals about what policy support is going to be provided, the speed of decarbonisation that's expected, and can therefore help companies and financial institutions to allocate capital if policymakers are communicating that clearly in a coherent way. These sector transition plans can also help companies to understand and navigate dependencies, what needs to happen for them to go further and faster. That's a very important part of the transition plan literature. And then it can also help, these sector transition plans can also help facilitate transition finance and the localization of transition plan assessment. So this is also something that's really important. You've got to understand the jurisdictional context. Not all transition plans are going to be the same given the differences in sectors and geographies and technologies. So it helps to make these more specific to the operating context in which companies and financial institutions exist. There are also some other case studies in this discussion paper which I commend to you. There's one focused on Japan. You'll hear more from a speaker based in Japan shortly, and where METI has created some technology roadmaps that have been very successful, and also in China and Hebei province is another case study. So I will stop there with my first hat, my first role, which was to give you that short presentation. And you can download these reports by following the QR codes. Now, I'm now joined by 4 fantastic speakers, and I've been told to not read out their biographies because they're very extensive. You can get them on the QR code in the top left-hand corner. But we have Marissa Drew, who's Chief Sustainability Officer at Standard Chartered. We have Kyung-Ah Park, who's Chief Sustainability Officer at Temasek. We have Naoki Shigetake, who is Chief Operating Officer at the GX Acceleration Agency, based in Japan, a key part of the Green Transformation Program in Japan. And we have Iran Guo, who is Director of Policy in the National Climate Change Secretariat, based in the Prime Minister's office in Singapore. So if those 4 speakers could come up to the stage in no particular order. Welcome. Thank you for joining us. Wherever you want to go. Okay, so I'm going to ask some questions. We're going to have some time also for questions from the audience, so please think about what questions you might want to ask. But the first sort of area I want to ask some questions about is in relation to the business case for transition planning. And Kyung-Ah, I want to start with you. and ask you, drawing all the examples in your portfolio companies as Temasek, could you share your view on why you think transition planning is important?
Yeah, so first of all, thank you, and great presentations, and thank you everybody for coming. So I'm going to just leverage what Alvin said and just double click, because I think it's really important to remind ourselves that we are a long-term asset owner and a generation investor. So in many ways, our portfolio is a microcosm of the real economy, and as a result, climate change risks are either directly or indirectly part of our long-term systemic risk issue. So we have to lean in and do the hard work in terms of both investing into the green solutions of today and the future and helping to scale them. Also going where the emissions are and really thinking about how do we help companies, because this is a global systems risk issue, help them transition, but do so in a very credible way. And then we have a number of portfolio companies that are in hard-to-abate sectors that we've owned from the very inceptions of Temasek that we will continue to hold. So how do we help transition them and future-proof them so that we can make sure that our portfolio is resilient as well? And then related to that, how do we actually work through some of the gaps in the overall ecosystem and be able to address them, whether it's in the context of carbon markets, and ensuring that we can pull forward some of these levers to be able to ensure that this transition happens well. And also we can ensure that we capture the risk and return, because we are at the end of the day a commercial investor. So it is very much integrated across all of those different levers. And climate transition plans, and Arunabha mentioned disclosure as well, are critical as an investor in terms of understanding how companies are actually doing, both as it relates to capturing the revenue, so the solutions that enable you to be able to transition faster, whether it's renewable energy, whether it's more resilient ag systems, doing green building materials, and that is a future where the growth opportunity is. And making sure that even if you may not have those types of solutions, so you're a great company, how are you future-proofing by making sure you are integrating it strategically, which is the key thing. And it's been touched upon again in the presentations. When we think about a credible transition plan, it's not a cookie-cutter approach and very prescriptive approach to say this is what you have to do, because each of the sectors are quite different. We also have a number of companies that work in and operate in emerging markets. So the transition pathway for emerging economies is going to look different than developing markets. So it's a principles-based approach. Again, none of this is rocket science. We built upon Ben's good work on the TPTs as well as transition pathway initiatives and a number of different frameworks. But we look at, one, governance. Like, does the company have good board oversight? Is it embedded within the management capabilities and the KPIs? Are they looking at this strategically, not only from a risk lens, but from an opportunity lens? And are they thinking about it long term, but breaking it down into the near term, as well as the medium term, and ideally setting some very clear targets? Do they have CapEx that is aligned to this? So we can see that they're implementing and investing against it. Are they actually disclosing in a credible way, with ideally over time, if you're not already doing it, some level of independent assurance and showing the progress, but also being very transparent about the challenges that they have and how are they actually unlocking those things? Are they advocating in an aligned way, particularly with developed market countries? So the list is very, very clear for us in terms of how we look for information and look at what credible transition plans look like. And then we also engage with our portfolio companies to see where their gaps are and set expectations and support them on that journey. And I'm going to come back at some point. I'd love to talk a bit more about how do we bring the ecosystem together between the early stage green solutions together with incumbent companies who need to pull forward these technologies and think through that systems lever and what does real good transition look like and how do we invest into that thematic? Because I think that's a very important piece of the overall jigsaw puzzle. But let me just leave it there and just say it's a critical part of what we do, both in the investment, engagement, thinking about the ecosystem connectivity.
Great, thank you, Kyung-Ah, and we'll definitely come back to those topics as we go. So Marissa, I wanted to ask you the next question. I mean, obviously a lot's happened since 2015 and the Paris Agreement, and the way corporates and financial institutions have approached climate change has progressed very significantly. Where do transition plans fit into that evolution, and how have you observed that in your organization?
Sure. Well, I think we are, as a financial institution, a little bit the model that Dr. Ghosh, in terms of the journey laid out for us, because in some ways I was saying, yes, check, check, did it, in that somewhat that progressive way. So for us, it started out by, first you have your ambition setting. I want to be net zero by 2050, and I'm prepared to hold myself accountable to 2030 interim targets. But as a financial institution, we are so much different than a manufacturing company. 97+% of our emissions are financed emissions. So it is the activity that we do lending to our clients. So if our clients aren't decarbonizing, we can't meet our targets. So it's an interesting place to be. And as a bank, we're not one industry. We're all industries. We're banking the entire suite of industries. So the first step for us in the journey was proportionality really matters, because where do you focus your efforts? And of course, it's not going to be a surprise, but we focused our efforts in the hardest to abate, but also the highest carbon emitting sectors first. Because if we can tackle them and they're on their journey, that is the 80% of our emissions. So we started with a proportional sort of approach. We set sector targets that are science aligned, very much grounded in science, looking at a pathway to 2030 and then 2050. And then what did we do? We had to engage with the clients that we want to be on the journey. And that was, if I'm honest, the most challenging part about this, because I can sit in my wonderful little center in CSO land and set all the targets and collaborate with my science partners and so on. But the hard graft is then going to my frontline bankers who cover oil and gas or steel or shipping and say, you need to engage with your clients on this topic if they aren't already on the journey. And we want to present ourselves as a force for good and as a support partner in the journey. So we want to lend to help fund the capital expenditures that someone might invest to decarbonize. Or we might want to support with capital those earlier stage technologies that could be the breakthrough technologies that will find the solution. But I have to say, if I, as a lending bank, and we're very focused with balance sheet on cash flows, it's less about those early stage breakthrough. And a lot of this is just process improvement. Constant little tweaks in these sectors to bring down emissions. But when you add them all up, they become very big. And if I can give you one example of what's considered a very hard to abate sector, and when we started the journey, to answer your question concretely, I remember sitting around the table with the shipping industry, and they were all saying at the original discussions, we're not going to be able to decarbonize anytime soon because we have no magic green ship. There is no such thing. And a methanol ship has all kinds of complications, and it's way, way out there somewhere. Same discussion in airlines, SAF, Sustainable Aviation Fuel, way out there. But as we started to challenge them and say, we're here with some balance sheet capital, if you'll get on the journey, let's not wait for the greenest ship ever. What are the little things you can do? The industry really stepped up, and they put bow thrusters on, and they used different kind of paint that smooths them through the water, and they had dual fuel inside the ships, and on and on and on it goes. Each one of those actions needed some money, and we provided the money, but then they created that multiplier effect of decarbonization long before we've ever hit the perfect methanol ship. So that's maybe a little expression of how the journey began. But also, very, very importantly, transition is a really complicated topic, right? Because what's green yesterday won't be green tomorrow. And it's dynamic as these new technologies come and they become commercial. So our way of communicating externally, to one of the points you raised in topic number one, is how do we communicate that we're providing transition finance and not have it be perceived as greenwashing? The way we do that is by being very, very transparent what we're labeling transition finance. So we have a transition finance, we've of course produced our own transition plan, but we have a very public transition finance framework that goes in really precise detail with by sector, what do we think is credible and transition activity versus what isn't. And then we will label transition finance in accordance with that. But I can tell you it changes on a regular basis, and we have very active discussions as these industries start to materialize and the new tech comes. The final point I will make is The other area that we find quite attractive is the idea there's transition activities, so a use of proceeds transaction where a company might raise money to invest specifically in decarbonization. But a whole nother area is what we call transition pure play companies. So this is a company who has more than 90% of their revenues going toward a decarbonization or transition activity. And we look at those companies in a rigorous way. So maybe a good expression would be a battery manufacturer. Well, a lithium, if you're a lithium miner, where is the end use of that lithium going? It could go in a cell phone, but it could go into an EV battery. If 90% of the revenues are going into an EV battery, we call that a transition pure play. And anything that company does is considered transition for us. Very publicly, we say that. But if half of their revenues were going into a cell phone battery that's not decarbonizing, we wouldn't count that. So this is where it gets really not complex and nuanced. But we learn as we go and very dynamic. And that's why partnership really, really matters with asset allocators, investors, new tech, data, all of that you also pointed out in your plan.
Yeah, thank you for that, Marissa. And I think that answer reflects the fact that we've moved from a kind of an overly simple way of looking at this, particularly from a financial institution perspective, divest or not, to something that's a bit more nuanced and also to something that is not just about box ticking and can capture the complexity that we're in.
Can I make one point on divestment, if I may?
Sure.
Many of you might be NGOs in the room, and I have to say that NGOs, when we started the journey, were very aggressive with banks. Why will you ever, if you really care about getting to net zero, why will you ever bank a fossil fuels company? Was the kind of conversation that we had, And my response back to them was, these are longstanding clients of ours that help build our markets. We know how energy is in many of our markets in terms of the total percentage of the mix is fossil fuels or coal or whatever. But as a bank, if we divorce ourselves from those clients and we say, sorry, we're not banking you, and in effect, we're calling them bad actors, we have no relationship with them. How can we possibly help them on their journey? Whereas if we say, we will bank you if you have a credible transition plan and we'll bank you in those decarbonizing activities, then we can use our money to help make it happen, which is exactly what we all want, which is getting to that end state of a greener, cleaner world. So I think the divestment point's a really important one. And if I can commend the Singaporean government, a really, really important point. They explicitly said, we expect our banks not to divest from these hard-to-abate sectors. We expect your role is help them on the journey. That was extremely helpful for me to say, my regulator is telling me they want me to do this activity, so we're all in this together. So I just want to make that point because it was a sort of an important one.
Thank you, Marissa. Okay, so now I want to spend a bit of time with the panel kind of exploring the links between public sector plans, NDCs, and private sector transition planning and plans. So Iran, with Singapore, obviously we're in the Singaporean pavilion, but there'll be people here who aren't that familiar with Singapore's NDC or its NAP. Could you say a bit about that? And could you also say a bit about whether you included pathways within that plan and how you thought about the private sector as you were developing those pathways?
Yeah. Thank you, Ben, and thanks for doing the presentations and having us here, and thanks everyone for being here. So for Singapore, we were one of the first countries to submit our 2035 NDC on time. We are really glad it's picking up now, but I think we need a lot more collective action on that. But when we do our NDC, we usually say we do a top-down and a bottom-up approach. So when it comes to I see a lot of people nodding, so I think this is a very familiar way of doing things. When we look at top-down, we look at complex energy modeling. Right, what are all the various technology pathways? What is the abatement that you can get at different points in time, and what's the economic cost? That gives us a very sort of factual view of what is the most efficient way of getting to your target. But we also know that the real world is a lot more messy than what a model shows. So we also do a lot of bottom-up engagement with government agency, but really the private sector, to say, what are you seeing? What are the pathways that you think works for Singapore's context, and what is stopping you? And then what is then their timeline and the support that you need to get to where you need to be? So I think when it comes, we don't call it transition planning in that language, and we didn't previously. But thinking back and looking at what Ben presented, that's really what we did. We went to the companies to say, if you were to meet your target and the Singapore national target, what are the things that you need to do and the financing that you need and enablers that you need? Maybe public procurement. How can we help you? So I think certainly companies there need to think through how is their transition going to look like in our national context. So I think in our NDC, it is fundamentally we have embedded a lot of the private sector views in that. I would just say that for the National Adaptation Plan, because Ben, you mentioned it, we are working on it. I would say for national adaptation, and maybe this is similar for many countries, traditionally, everyone expects the government to take on the full load of it. And I would say for Singapore, that has sort of been a natural assumption as well. But increasingly, we're seeing that the needs are so great. And I think more than just who pays, it's also that when you engage community, but also the private sector, you get more of their buy-in and you get better ideas. And so I think we are right now going through a process to develop our national adaptation plan and to review it because we've always had some form of it. We are starting to also think about how to bring in that private sector angle. I think that's the first part. On the second part, sorry, Ben, your question?
Well, it was really about, why you've done that, but you've sort of explained those things.
So I think maybe just one more point to that. So for transition planning, what we also would like to see at a national level is that interdependency across sectors, which Ben, you talked about, and we completely agree. It is very normal for sectors to sort of think within their own company and then within their own sector. But there's so much interdependency. For example, we've been working with the logistics sector. And we all know that they are such a big contributor to other sectors' Scope 3 emissions. But each of these individual sectors may find it hard to catalyze system-level changes for another sector that they all depend on. So how does the government come in to bring together those different perspectives and try to say, as an entire economy, we move together rather than do it in silos?
So a follow-up question for you. I mean, how do you conceptualize the dialogue with the private sector? So you get to a point, we're getting to a point, we're not there yet, where a lot of key companies in an economy will prepare a transition plan grounded in their corporate strategy. That should inform government policy making. How do we make that work and how do we make sure it's iterative and dynamic?
Yeah, so I think, Singapore is a relatively small economy with a relatively fewer number of players. And I think we've always had the tradition of very direct and continuous engagement with the biggest economic players. So I think it has always been embedded in the way we do industrial policy, the way we support companies. But going forward, I think to us, the biggest value of a transition plan is that the companies think through what they need and their risks to get to where they need to be. And when you aggregate that, it helps inform the government of our blind spots. So I think decarbonization, we talk a lot about it, but to us, climate risks is really another big part, especially because different companies really face different climate risks, and many of them are sort of even beyond the Singapore border. So when we get that perspective from companies and then we aggregate them across, I think it also shapes at a national level what are the partnerships that we need, including with other countries, with international organizations that can then enable the companies to develop in a much more sustainable way.
Yeah, I mean, I think Singapore is unusually joined up, so maybe the question is it's a bigger deal for other jurisdictions that are less joined up. And so a jurisdiction that I know well, which is the UK, and I'm on the UK Climate Change Committee, we in the UK system, it's not clear yet who would be responsible for analysing the different corporate transition plans, identifying the dependencies, and how that would neatly then feed back into climate policy and industrial policy. And that, I think, is one of the things we need to work on in terms of the future of climate architecture.
Just a very quick point to that. You're right. I think Singapore, because we're small enough, we have always been quite coordinated. I'm from the National Climate Change Secretariat. We're in the Prime Minister's office. And I think we do take it upon ourselves to work with our agencies to have that whole of economy view. So that's something that's very important because we do know in much larger countries, it's not always easy to have that national perspective.
Okay, so thank you for that. Now, Shigetake-san, Japan is actually another jurisdiction where you have a very joined up approach through the Green Transformation Program, which I'm very excited about. I know other colleagues are very excited about it too. It's hugely important, globally significant, actually. And it'd be great to hear more about that, more about your organization, the GX Acceleration Agency, and how that agency, your agency, is helping Japan realize its ambitions.
Okay. It's hot, isn't it? So forgive me my attire. But, so thank you very much for inviting me for this panel. My name is Naoki Shigetake. I am a CEO of GX Acceleration Agency, in other words, GXA. Hearing what you guys are saying, I'm very glad to know transition planning is not an obligation for the companies, just to comply with disclosure needs. But transition planning is more a strategic tool to think through the strategy to go, the difficult journey of transition. So to explain what we are doing in Japan, let me start explaining what Japan's GX strategy. GX stands for Green Transformation. It has two goals. The one goal is, of course, decarbonization. The other goal is economic growth through enhancing Japan's industrial competitiveness. Those two objectives are not either or, it's and. So GX strategy, under GX strategy, we need to accomplish both goals simultaneously. To fund this strategy, Japan issued a GX bond, which is, I think, first sovereign climate transition bond of 130 billion US dollar. By using this money as seed money, we call for 1 trillion US dollar public and private sector in total for GX-related investment in the next decade. And then GX strategy has two features. One feature is the balance between subsidy or support and mandate regulations, because too much regulation, too much mandate will cause a risk of carbon leakage, and then too much subsidization may cause inefficiency in the projects and also fiscal constraints. So it needs to be a well-balanced management. In other words, it's a carrot and stick. Carrot and stick needs to be managed in a well-balanced manner. Another feature of Japan GX strategy is the emphasis on transition. I think in 2023, G7 Hiroshima Summit, Japan proposed a concept called One Goal, Various Pathways, which means we share in the world the same goal, which is a net zero, but the pathway go to the goal should be, should depend on the situation of each country and each region. So the transition, the concept of transition is very important. Then GXA was launched July last year as a driving force of Japan GX strategy in a very balanced manner, as I explained. We have three roles. The first role is to provide financial support by taking the risks which private sector cannot take. The second mission is to introduce Japan's first mandatory ETS system, which is called GX ETS. So GXA manages both carrot and stick in a balanced manner. Then the third mission is to promote the coordination of, I would say, collaboration between companies and within the industry, beyond the industries, and also across public and private sectors, because the challenges of GX cannot be completed by a single company alone. It needs to be collaboration across the sector, across the private and public sector, across the company, across the supply chain is critical. So that is our role.
Fantastic. As I say, hugely significant what you're doing in Japan. I mean, one question I had for you, and I'll also ask the same question to Iran, is how do you balance, national priorities, national objectives with, international objectives? Are they aligned? Are they misaligned? How do you adjust and course correct? And how does the international feed into the national?
Okay. I think two things. One is as I said, Japan emphasis on transition, which is very different for a pressure of, in the global pressure of quantum leap to green. So we need to, manage that kind of gap. So, for example, there is always a discussion or argument over ammonia coal-fired, power plant. I think we believe it needs to be done for the transition, but sometimes the pressure is, you have to change coal-fired power plant green instantaneously. But that's not, actually impossible. And the second point would be, I would say, the metrics. I would propose, in Japan, people started to speak about avoided emission as opposed to CO2 emission per se, because under the transition, I think not the absolute quantity of CO2 emission, but avoided emission may be more appropriate, metrics.
And Iran, same question for you.
Yeah, so thanks, Ben. I think first part of my answer is very similar to what Japan is going through. I think when we think about national pathways, national policies, a lot of it is anchored on not just where you want to be, but where are you today, and the context that you are placed in. So for Singapore, we have almost no renewable energy whatsoever. We are too small to harness solar, and we have nothing else. So I think when you start from that perspective, our decarbonization journey would necessarily look very different from other countries. And I think we need to be able to say that in the open and not be afraid of doing so, to be fair to the country, but also our companies that operate within Singapore. And we are also, of course, in a region that, compared to, say, especially certain other regions, are still growing very rapidly, with their energy system still very much dependent on coal. So where are we today? I think that recognition is important. But at the same time, we are a very open economy. And we are a trading hub, we are a financial hub, and I think that interoperability then becomes very important. So I think when we think about policies, it's not always about I think it's different between standards, but also interoperability. You can have different standards for different regions, but how do you define, right? How do you measure, and how then do you stack up the different parts of the supply chain to get to that end number, which can be different. So I think when we think about our regulations, our policies, the standards that we sign on to, we think about that from a very sort of structural angle. But we can, say, have a different pathway or a different timeline to get to certain end outcomes.
Yeah, okay. Thank you for that. Super interesting. I mean, I think there's this sort of constant tension, isn't there, between the global goals, the national politics, the national goals, and what we can expect from companies, and then the role of finance in supporting companies in the real economy. And I think sometimes, and this is maybe the original sin, going back to the comments that Marissa was making and we were talking about, that the assumption was that the same goals needed to apply to every level. And actually, what transition plans are trying to do are to sort of encourage actors to go, companies in particular, to go as quickly as they reasonably can do. And I should also say that the guidance that's now owned by and maintained by the ISSB on transition plans is designed to be applied to any companies operating in any sector, any geography, and that's partly because they aren't saying to companies, this is the target you must have. They're giving them flexibility. Okay, so I want to go back to what the private sector's doing and getting a bit more into operationalizing this in different types of institutions. So Kyung-ah, I want to ask you, as a big investor, a massive investor, what is your, and you were starting to answer this, but could you say more about your baseline expectations for a prospective investment in terms of transition plans, and how you will go about assessing the credibility of that transition plan over time?
Yeah, so for prospective investments, We require all new investments to have a materiality analysis for ESG, regardless of whether you're a green company, gray company, or life sciences company, or an energy company. And as Alvin mentioned, we apply a consistent $65 for Scope 1 and Scope 2 emissions. And where it's material, I think it was earlier said, Scope 3 is quite difficult. But we will take a look at what is the material exposure of Scope 3. Alongside that, we apply also a climate value at risk analysis, and then take a look at what a transition plan looks like. But to Marissa's point, given how many investments we do and how diverse our portfolio is, we also have to right-size our return on engagement and how do we spend our time thinking about what are the material risk issues, what are the mitigants, and then post-investment, how do we engage? So just to be very clear, the way we actually look for information and how do we think about post-investment engagement can look different depending on the materiality of our investments, what is their influence and governance rights, as well as what is the actual type of sector and where are they in terms of the market. So it's not a one-size-fits-all. But we do have a consistent way of applying the carbon pricing and looking at value at risk and so forth to inform how do we actually think about that. I think the other part of which I mentioned is we have a framework, a principles-based framework on climate transition readiness. And for our largest emitting companies where we do have influence, and many of them, not surprisingly, are based in Singapore, and many of them are in hard-to-abate sectors, whether it's airlines, ports and shipping, or in the power sector. We actually have a maturity assessment that we do at a minimum annually, and in some cases, actually even more frequently. And what that does is we also take a look at benchmarking and what does good look like in their respective sectors and markets. And that helps us inform where is the areas that we want to actually engage and set expectations. It's not a one-size-fits-all. It takes a lot of elbow grease. But for the biggest emitting companies where we have influence, it's worth the effort. And over the course of the past year, I actually went through a very detailed decarbonization mapping exercise to say for aviation, for power systems, what are the decarbonization levers that they need to be unlocking? But we don't say you have to go into green hydrogen today if the economics doesn't make sense. You have to go into 100% sustainable aviation fuel procurement today when it's 3 to 5 times more expensive. But by having a decarbonization dashboard that we monitor on a regular basis to see how is the actual techno-economic cost curve changing, where are the actual pilot and commercializations actually happening that we can learn from, what are the technologies that we've invested into and where are the inflection points in terms of commercialization? And when the economics and the commercial impetus makes sense, then what we can do is pull forward these technologies and marry them with our incumbent companies and encourage them to potentially be an off-taker for this. And because Singapore, we have very enlightened policymakers and a relatively tight ecosystem, we're able to also test bed and pilot some of these things and see how does it actually work in practice. So sustainable aviation fuel is a great example of this. We're a majority owner of Singapore Airline. It's probably one of the hardest abate sectors. I'm sure most of you flew long haul. And even if we may upgrade to energy efficient fleets, try to actually, think about electrification. Those only tend to be for short haul. Long hauls need sustainable aviation fuel, and as I mentioned earlier, it's 3 to 5 times more expensive. And you've got to think through also how do you operationalize it on the ground to be able to bring that into the actual, value chain, make sure that Changi Airport can then, put it into a system, and then the airplane can off-take it and put it into their planes. And so we did a pilot exercise together with our colleagues. I don't see our Gen Zero colleagues here today, but they're here in full force in Belém. Where we actually worked across and pilot tested how do you do this in practice, and also think about how do we monetize this to a carbon credit mechanism, so a book and claim mechanism, and bring the demand side, the travelers and corporates who need to offset their travel emissions and pay a little bit more by becoming an off-taker of sustainable aviation fuel credits. And it's a very high quality way of thinking about insetting across the value chain, right, and being able to pay a little bit more. And off of that, Changi Airport basically built the confidence to put a sustainable aviation fuel mandate in place. It's 3 to 5% by 2030, and it's a bulk procurement, so level the playing field, and then the airlines can pass it through. It's pretty nominal in the context of the plane tickets. And Singapore Airlines also said it's going to do a sustainable aviation fuel, target. And then we also put together, Gen Zero and World Economic Forum put together Green Fuel Forward Buyers Coalition, which we are participating in, to be able to pull together that travel emissions offset and be able to pull forward the sustainable aviation fuel credits. And that demand signal can be very powerful if it scales in giving the confidence for the airlines to do more. So we have to think through how do we stitch this together to be able to enable hard-to-abate sectors to transition and really bring the supply demand side, the policy frameworks, and test bed some of these things and accelerate the transition pathway and do the hard work and make sure the economics actually make sense, because again, this has to go hand in hand with the commercial impetus as well.
Thanks, Kunal. Marissa, I had a similar question to you. So let me repeat. What's your baseline expectation for a prospective client, and how do you assess credibility and progress over time? But one additional element to that: what would you like to do more of in the future that you find hard to do today?
So we look at it from two lenses. One is a risk lens in some respects, and then the other is in the opportunity side. And they have to go hand in hand, because if you think back to what I was describing earlier about the journey we've been on, if I have just gone to my frontline bankers and said, all your clients have to decarbonize, whether they're, on our timetable or not, the way a frontline banker would absorb that's a tax on my business, right? Or it could potentially take business away from me. We had to actually present the opportunity set hand in hand. So step one, though, is to try to assess our clients. And that is a basis for engagement. So when we do a climate risk assessment on every client in our loan book, we have a methodology that will throw up red flags. And everybody wants to know where they are, right? If I go to a client and say, you've got a risky little red flag here, everybody's very curious what that means and how do they do better. So it's this moment, it sparks a moment of discussion for a client about, if you don't transition or address this risk in the case of adaptation, this is a risk in your business, but it's also a risk for us as a lender and a credit for us. So we find that to be a really wonderful tool to start the dialogue. The other thing that we have done is, unlike perhaps a private equity investor, say a Temasek, the flow in a bank is a lot. We do thousands of transactions a year. So we don't have the capability or capacity to spend months, hours, weeks assessing a client. But what we can do, back to our proportionality and materiality, is we can have good benchmarks for what a credible transition looks like. I call them good markers of hygiene. And then we assign scores. We actually have now a mnemonic in our bank, CTP score. And those numbers range from low to high. And so every one of our clients, as we're evaluating doing business with them, we look at the CTP score. And when we're thinking about whether we would label an activity, transition activity, whether it would qualify as a pure play transition client, that CTP score really matters. And again, that's another basis for conversation with the client. Many clients say, well, how do I increase my CTP score? Some of that is very easily within their control about their ambition setting, delivering us a transition plan, whatever it is. And in some cases, it's much more complex. It is, you need to invest in emissions reduction technology in your business. So it's all over the map. But that gives you a little bit of a flavor of how we do this. For those very, very high emitting clients, which make up a disproportionately larger percentage of our loan book, we call them the Transition 50. We've identified 50 clients with whom, if we really, really can get them to participate and accelerate, guess what? It brings our loan book emissions right down. So we want to expend most of our effort there. And there, we do everything in our power to help show them what good looks like, share best practices from other markets around the world, use data tools to say, I know you think this is really hard, but someone who looks just like you is doing it over here. What are those mechanisms, and so on. So it's it's a very, very comprehensive suite of things that we do. And then it's not just one time. Then we're constantly checking about the progress. If someone has a credible transition plan, we go back a year later and say, are you still following the journey that you promised that you would be on? And we will go so far, because it's our reputation at stake. If we've labeled something transition or green, and we look back a year later and they haven't met that trajectory, we will delabel them, if I can put it in those terms. Not real world, but we would pull the label. And that comes at our own expense because we have also, in addition to decarbonization targets, we have sustainable finance revenue targets. And so that would hurt our revenue target. That nobody wants that, but we're prepared to do that, to make sure that we maintain our own credibility. So I don't know if that gives you a good enough flavor of how we do it. The final point I would make is we also need a fair bit of innovation in this space. And some of what is going to get us there to meet a credible transition plan, if there truly isn't the technological solution, and our client has done everything they can operationally, it is credible to us to purchase carbon credits for that last hard-to-abate mile. So we are big proponents of making sure we have a functioning credit market to help to offset where it truly isn't abatable. That is equally credible so long as you've done everything you can operationally.
Great, thank you, Marissa. So Shigetaki-san, I want to come to you, and a sort of a similar question, really, which is, the GX Acceleration Agency, you've been set up to finance companies in Japan that are transitioning. What is your baseline expectation of those companies seeking funding and finance from you in relation to their transition plans, and how are you kind of embedding transition plans in the instruments that you're creating? I'm aware that it's still quite early days, but what's your thinking?
Okay, I think as Ira-san and Kyona-san explained, it is really important to think what to do in terms of green transformation. It's also challenging, but it's more challenging to think about how to do than to do. To help the companies think about how to do, I think government law is critical. So what we do is we offer end-to-end support for transition, because the typical GX project needs to be completed end to end. So, for example, if you think about green hydrogen or green ammonia consumption, you have to create green hydrogen, green ammonia production, and also you also have to create the demand for green hydrogen and green ammonia. You cannot do either one. You have to do things both. So that's why we offer support end to end. For the upstream, we offer, let's say, subsidization for capex of green hydrogen project, and for the downstream, for the off-taker side, we offer CFD, which is a price gap subsidization. By doing so, we can complete end-to-end support. Then the supply chain can fly end-to-end. I think that is important.
Great. Okay, I'm conscious of time and want to open it up to questions shortly, but final question before we open it up for each of you. And I want to start with Iran first, but same question to each of you from your different perspectives. How can the public sector drive the adoption and use of private sector transition plans?
Thanks, Ben. I think that is a really important question and one we've been really working on. I see Kavita from our Sustainable Finance Association. So we've been working very closely. So I think from the Singapore government's angle, we've been trying to unpack the question, it's a strategic tool, why are not enough companies doing it? And I think one part of it is that we hear feedback that they're very scared, which is similar to what Marissa said. They are afraid of putting out things that don't look perfect, and because they could be judged, they could be accused of greenwashing. But that is not very helpful, because we also hear a lot of people who've gone through the process say it's a multi-year process. You improve every single time you do it. So how do we break that cycle? And I think here in Singapore, we're trying to figure out what can the government, together with the industry association, do to, well, one part of it is give some air cover, but part of it gives some confidence. What is good enough as a start? In a way that is still credible, but may not be perfect. So I think that's one big part about on that. The other second point is we also hear a lot of feedback that says, okay, I've put a lot of resources into my transition plan, but who is using it? I mean, they may not yet see what the banks or their asset managers are doing. They may not see better loans or more loans. And they are also wondering at the government level, how is your policy changing in response to what I disclose? So that I think there is more that we can do as an entire ecosystem. Sometimes we do take that into account, but it's not very transparent, and we don't directly acknowledge how our policies, or maybe banks, the way you decide on things, have changed in response to their transition plan. I think we can do more to make that a lot more obvious, so companies also get the confidence to continue doing it.
Great, okay. So I'm going to ask Kyung-ah to go next, but maybe to make it a sort of a fairer question, what can governments that are not the Singaporean government do to drive the adoption and use of credible transition plans?
I think you said it really well, which is, you know, on the one hand, you can mandate it, right? Which is essentially what many enlightened governments are doing, but with a glide path. Because if you're a very large energy utility company, as you pointed out, you know, many of them are already on this journey and actually getting some of the pricing benefits and recognition from the market. But there's also sectors where arguably transition risk is not necessarily viewed as a big material issue right now, but that may change. So if you're in a services, asset light sector, you may not think about it the same way and have the same pressure points. But I do think it is inevitable that it's either indirectly or directly going to be actually a risk and an opportunity, by the way. So one way is to do it as a mandate, but ensure that there is actually decision useful disclosure. So you're not just disclosing and ticking the box purely because it's mandated by the government. And so that capacity building is, I think, a really important point. And that's the case for small enterprises in developed markets, but importantly, emerging markets, right? We're here in the heart of Brazil, you know, next to the Amazon, and there's even least developed countries where they don't have the technical capacity or the support to be able to do this. And they're among the most vulnerable and need arguably even more urgency in terms of capital flows and recognition from the markets. So we have to keep that in mind. I think the other thing I would say is, again, I come back to what motivates people. And unfortunately, even though we all in the room care deeply about what the future looks like and doing the right thing or what's a moral imperative, I would say the bulk of the people outside of the COP30 process and outside of the sustainability community is still motivated by dollars and cents. So we got to give them the right signal on why does this matter, certainly from a risk perspective, but to your earlier presentation, the opportunity side of the equation, which is, like, we have portfolio companies. I'm hoping there'll be many more proof points, but both in the public market, but also in the private market, where when they've gone on this journey to go from more of a carbon-intense gray company to a greener company, where the growth trajectory is much faster. So Sembcorp, which many of you know in the Singapore ecosystem, is the actual power and urban solutions provider. They used to have coal assets, they still have gas, but they're going very long into renewable energy and setting very, very ambitious goals, right? Doubling to 25 gigawatts by 2028, putting actual capex against it. If I remember the numbers correct, it's like $10.5 billion of capex, being very transparent about it to the market and telling their story. And as a result of that, their share price is, I think, more than tripled since they embarked on the journey over the last several years. We have another company called Topsoe that's a private company. It's been around for like 80 years, a Denmark company. And they used to provide catalytic and process technology to refining and petrochemicals, very carbon intense. What they're doing now is taking those capabilities and saying, I'm going to go and do power to X, hydrogen, sustainable aviation fuel, building the next cutting edge generation of electrolyzers, and going all in this and trying to help companies transition. And to your point, starting to measure for avoided emissions and starting to get credit. I mean, we're a shareholder, so we give them credit, for that. But it's a faster growth trajectory, and this is where the future is. But you've got to balance, obviously, your incumbent business, where it's right now generating cash flows, as well as you need it for energy security. But then as you progress into the growth of the future and getting credit for that because it's faster, and that's where the innovation is, it's telling that story to the market and getting re-rated. And we see many examples of this starting to happen. On top of the points that you mentioned around cost of capital, We forget insurance. Many of the insurance companies are pulling away from certain sectors, certainly coal, but other sectors as well, as it becomes more carbon constrained on top of the physical risk aspect. So these are actually speaking in terms of dollars and cents. And we've got to tell that story better and also be able to ensure that the near-term benefits are being recognized and not just the longer-term opportunity sets.
Yeah. Thank you, Kungal. And Marissa, I want to go to you. Same question. How can governments make this easier for you and your clients?
Yep. So to me, when markets have confidence and scale and we get more people to join our movement is when there is a consistency of communication. So for instance, I think we're one of the first banks to publish a transition framework back in 2021. There weren't many others doing it. What we can't have is if my bank says a credible transition plan for a company is rated 55 and somebody else has a different metric and rates them 75 and yet a third bank rates them 25 and we all use a different set of criteria, you can imagine the company's ability to absorb that is almost nil. A lot of those scores are related to things like a credible transition plan isn't always just an ambitious decarbonization target. It could be, are you disclosing? Because credible transition plans have to come with transparency. So if we can start to unify what we mean by a credible transition by sector, and then if governments endorse that, and we're starting to see this type of a movement where coalitions of governments are saying this is what a credible transition plan looks like, and here's guidance on that, and we get some harmonization across countries, that is a big deal because then those companies that are a little bit nervous about this say, I'm being told for my sector what does good look like with the nuances that are regional and all the things that we must have in there. Second thing I would point to is very much stability of government policy. And Singapore is wonderful, but not every government is as stable with its commitments. Imagine if these companies start moving and making huge investments because the country NDC says, I want my energy mix to be 50-50, or we're going to ban petrol cars by date X. That's an enormous movement. If you change that, that undermines the very transition that we're trying to create because you've got to have, these are not immediate returns on investment, they are long-term game. And the third thing I would point to, exactly as you said, is that celebrate these successful outcomes. When we see a company really moving, or a sector, like we said with shipping, we never expected they would decarbonize as fast as they could without that green, fabulous methanol ship. Celebrate that. Really, really talk about that because other parts of the world will then join in. And once again, I think we build confidence to those who haven't yet joined the journey.
Thank you, Marissa.
Ben, sorry, if I could just add one
Sure.
point. On interoperability is so important, and I think just wanted to say that Singapore, for our taxonomy, which is a very complex thing, we came up with our own, but then we are working very hard to sort of integrate that with the ASEAN taxonomy. But beyond that, we also came up with something called the multi-jurisdiction common ground taxonomy that actually transparently lays out how our transition taxonomy is vis-a-vis the EU and the Chinese taxonomy. And these are big, major financial markets. And I think we can do a lot more of these to help global companies. Yeah.
We can't have 500 taxonomies. We must have overarching principles and then ability to interact depending on what your country or your sector or your maturity level is, for sure.
Agree.
Yeah. Thank you. Good point to make. Shigetaki-san, same question to you.
Yeah. Let me emphasize again the importance of blended finance. In other words, it's a government law, particularly current circumstances where because of the inflation, cost increase, and the many GX-related projects can be reconsidered, or it cannot be viable economically without support. So I think it's relatively easy to think what to do, but the real question is how to do. So you can make a good transition planning, but the challenge is how you could really implement that transition planning. So in that sense, the government support, blended finance is critical. But I'm not just saying, one side support from the government and then private sector just can receive it. No, because private sector needs to do something. So what I'm saying is a collaboration between public sector and the private sector. Think about how to share the risk, share the expertise, and do whatever it takes to make it happen. So you cannot slow down the GX-related investment now. So I think the governmental blended finance is very important.
By the way, I've just noticed that the Koreans have copied GX. There's KGX. We've seen on the pavilion. Anyway, so the Japanese approach is spreading. Okay, so we've got time for just a few questions from the audience. I'm going to just do a batch of 3 and then see what the panel wants to respond to, and then we'll conclude. Who wants to ask a question? Yes, there's a microphone. If you could just say who you are and your affiliation, that would be great.
Hi. Good afternoon. My name is Ransford Saki. I'm from Ghana. I work with an organization called Chains Afrique. So we are a secular economy organization in Ghana. We are trying to help civil society organizations and other industries as well to integrate green into their plans. So my question is, there are, of course, Standard Chartered in Ghana are doing marvelously well when it comes to green banking. But the problem is the banks, which Standard Chartered is included, they are not open to helping smaller organizations like my organization, Chains Afrique, to help other organizations as well to include green principles in their modes of operation. So I want to ask, is there any, of course, any of the panelists can help, is there any opportunity for such smaller organizations who are championing green transition in Ghana or in Africa? Because as much as Singapore will go very ahead in green transition, you can't leave Africa behind. We have to come along with all of us. So is there any such opportunities for maybe to build capacity or to open up the markets for such small organizations to help CSOs here?
Okay.
Thank you very much.
That's a great question. Thank you. And Marissa, I'll get you to kind of pounce on that in a second. But any other questions? Yes, gentlemen, just there. Name and affiliation.
Thank you so much. So this is Obed, and I'm from STPI Pakistan. So basically my question is that, Pakistan is one of the countries that has recently just gone through one of the most rapid renewable energy transformation. And now resultantly, a coal fossil fuel assets have actually, utilization rates have substantially dropped. And they're kind of now in a position where they're kind of an asset for the country, where there's underutilized capacity, there's stranded costs associated with them, and now the government is actually kind of trying to see how to transition away from them. But we actually have these long-term agreements. So I have actually two parts. The first one is that how can, since the government wants to work on it, how can a platform such as the ITPN kind of support any such efforts that the country wants to take? And secondly, that's perhaps something on my end, that how can actually we mobilize the private sector particularly to kind of invest in any such initiatives that, and where exactly is the business case for this whole transition? Thank you.
Okay, thank you. And anyone else want to ask a question? No? Okay. Oh, yes.
Hi, everyone.
Affiliation?
Yeah, Catherine Chen, Advice Sylvania. I guess my question is, I think the importance of working with your existing portfolio companies and clients to help them transition. I'm curious, where do you see kind of the most exciting emerging areas of business revenue that, to the gentleman's point earlier, could be new, around the corner, could maybe supersede some of your existing activities much faster than expected, and create entirely new industries? I think especially as countries look to the most difficult to abate sectors, at some point, maybe that might be supplanted by entirely new industries.
Great question. Okay, so Marissa, do you want to go first, and then maybe Kyung-Yar to address that final question, and then if anyone else wants to pick up on threads, they can.
So I think you brought up 2 points which I think are slightly separate but maybe interrelated. You mentioned circular economy, which isn't necessarily always purely decarbonization. The principles of circular economy are about how do you design upfront less materials in a resource-constrained world? How do you keep them in circulation for longer? And then at end of life, how do you do a better job with the waste, I think. So that's a whole big topic. I have to say, I'm glad you actually asked that, because we in my CSR organization, I just set up a circular economy innovation hub because for the first time, I'm starting to see business models emerge, commercial business models that at their core, they are circular in nature. It's one thing to have circular practices and try to do better with your waste stream and all of this, but actually the business is a circular economy business. It could be agricultural waste to energy. It could be desalination. There's wonderful advances in packaging, which are truly natural and they'll be compostable and so on. It kind of gets to your point about what some of the industries that we're seeing that are just emerging, that are just on the cusp of proving that they can get to commercial scale and really be at parity with what they're going to displace. And oh, by the way, they're sustainable. So, of course, what's not to love about those? And I see them beginning to scale. So we're having a concerted effort on that. One of the things that we're doing with government is actually working with government about how could you put in industrial policy making a requirement or an ask for more circular principles to be taken into consideration. I think those policy nudges, if you say, I am not going to allow, let's say, plastics in my waste stream when another alternative is available. I'm just throwing it out as a hypothetical. Imagine how quickly you'll create an industry and you'll address that point. I think a second point you were asking, if I'm interpreting it, was for smaller companies, SMEs, which are often the engine of the economy in countries like Africa and many, many other places, how do I either get capital or how do you engage with me? As a large bank, we have all sorts of issues dealing with very, very small companies because our machine getting it going to address very small clients is a tough one. On the other hand, we are a supply chain bank. We are a trade finance bank. And who's in our supply chain? Thousands and thousands and thousands of small and medium enterprises. So one of the ways that we're trying to manage fostering green and best practice is saying we as a financier will provide preferred terms if we have a green supply chain. So the big buyers at the end of a supply chain, these big global companies, they're nudging their suppliers to green up. We're saying to those big companies, we'll provide you better financing terms. That can be passed down to help pay for some of the greening practices, and then we create a lovely virtuous circle. So that's just one small example. It's not the only example, but I don't know if that answered your question, but hopefully that was helpful.
Kyung-Gon?
Yeah, actually, I'm going to answer Catherine's question, but also this question around Pakistan as well. So first on the opportunity sets, I totally agree on the circular economy, so I'm not going to repeat that point. We were actually on a closed-door session yesterday where one of the big scientific gurus were presenting the tipping point, the negative planetary boundary tipping points. But he was also making the case around positive tipping points, where technology had these S-curves, and when you reach that inflection point, how quickly the adoption and the economic case become a self-fulfilling prophecy. We've seen that in solar, but battery energy storage system is another super exciting area. EV, in some country contexts, is already there. In some others, I think we're still early in the journey. But we see these inflection points happening across many different technologies, and that's why we do invest into some of the innovative early-stage companies, including, by the way, we talked earlier about nuclear while we were chit-chatting, and so you need all of these technologies, right? And there's a lot of innovation going on there. But what excites me perhaps more so than that is the business model innovations that are actually happening. And I think that's very underappreciated. So for example, with many of the renewable energy companies that are developers, they now have many operating assets that become very long-term resilient cash flow yielding, where there are pension funds, insurance companies, that lower cost of capital, that wants to be able to benefit from those yields. So you can do an unlock around that creates value creation. In markets like the US, where there's major data center capacity coming online, and there's a massive issue around grid, the AI, software, battery system technologies are now unlocking companies that are enabling battery system to put into consumer, household, as well as buildings. And they own the battery systems. And as that scales, that becomes like a virtual power plant that brings the electricity cost down for the demand side, enables the supply side not to have to build again, and also when there's grid bottlenecks, and be able to meet capacity requirements in a much more dynamic way. And that's garnering multi-billion dollars of capital flow as an example. The other thing that we see coming back to, again, how we need to think about this in a global systems approach is actually there's a lot of incumbent companies that want to invest into this, but the market in the near term don't want them to spend that much capex from the balance sheet because these can be multi-billion dollars of capex requirement that, to your point earlier, materialize over a very long period of time. The cost of capital has changed quite a lot, so it's become quite costly. So what they're doing is actually saying, look, I have the capabilities, like CCUS capabilities or hydrogen capabilities. There's a lot of infrastructure investors and private credit investors that want to invest and allocate capital. They're partnering together and forming strategic joint ventures and taking these off of the balance sheet, right? And being able to turbocharge them in the private market. And there's many, many examples of these types of business model innovation that makes it very investable and enable you to do the value capture. Coming back to Pakistan, and this is where I wish there were more stories being told because everybody says, oh my God, emerging markets, they're going to be behind the curve, etc. But Africa, there was a climate convening earlier this year. I wasn't there, unfortunately, but I hear from everybody who attended, there's now a new vision of Africa that says, look, the green industrial future is my future, and I'm going to figure out how I'm going to do that and how I'm going to invest into that and make it investable. That's an incredible optimistic vision versus in the past, they were waiting for capital to come in from the developed markets and say, you guys spew GHG emissions, we're the one who are the most vulnerable. That's a defense game versus an offense game. Same thing with Pakistan. My understanding is that because solar module prices have obviously come down dramatically because of China overcapacity, and because electricity prices were going up, and the subsidies were being taken out, and because the grid was not the most resilient, now people are adopting solar at massive scale, and hence why you're having this stranded asset question and this coal and grid question. And this is sort of where I do think it's an important example of, you may have thought coal was the best way to go when you invested into this, but how quickly technology inflections are happening, and we've got to think about the stress testing and avoiding stranded assets. But I want to come back to a conversation that Singapore had yesterday around traction credits, managed coal phase out. This is a good example potentially around how you can actually help phase down these coal plants, right, and be able to compensate for some of these things by using carbon credits. If there's a credible mechanism around additionality, leakage, et cetera, where carbon credits can actually buy down some of those costs. Devil's in the details. I don't know if that's going to work in Pakistan or not, but we've got to think through all of these credible mechanisms and all the different levers.
Can I just add one thing to that is because of these how quickly disruption may happen and you end up with stranded asset risk, I do think as a country industrial policy matter, it is well worth us challenging policymakers to think about how quickly those curves may accelerate to the positive tipping point. This is what we learned yesterday is, when it happens, it might be a slow, and then bam, it happens. And then everybody freezes. What would you do in that scenario? And you can look to other markets where it may not have been handled elegantly, but with the benefit of hindsight, you could do it better next time. And I would point to perhaps the UK. Coal shutdown has happened quite quickly in some of the parts of the UK, particularly in the north, and it left thousands of people out of jobs. And yet there is a manufacturing capability in that industrial center that now they're saying, well, I had all this capability. How about repurposing a lot of that intellectual capacity and some of even the infrastructure and turning it into green materials and chemicals that are much more sustainable? And that's a transition from fossil fuels to something completely different, but it'll have a new use case and have some ability to take existing infrastructure and skills and repurpose them. But I do think we do challenge governments in countries where they are dependent on a lot of these sort of old school, high carbon emitting technologies, that it very well may come faster as these cost curves hit than anyone ever thinks. And the best preparation you can have is to be prepared.
Actually, can I just add?
We're nearly out of time, so you're going to have to be very quick.
Quick intervention.
Yeah.
Because on this point around technology and leapfrogging, and I mentioned business model innovation, largely in the context of developed markets, But there's actually so much innovation going on in Africa, in Pakistan, and other countries, where we now are able to invest through one of our partner platforms called Leapfrog into pay-as-you-go solar, which is radically turbocharging distributed energy access and making money and saving a ton, both in GHG as well as energy costs, for consumers, but also battery swapping technology for 2-3-wheelers, like in places like India, in emerging markets. So this is a power of Leapfrog and innovation, and we got to tell these stories more, because I don't think people really realize how much is actually happening on the technology and the business model innovation, and what this means in terms of all the co-benefits on top of making money, by the way. So anyway, sorry, you just triggered there's some thoughts around what's happening in developing economies, because I think it's a very, very powerful opportunity.
Okay, so Shigetaki-san, very quickly, and then Iran, you'll have the last word.
Yep, quick and very pragmatic comments. So already mentioned, but I think you could think about carbon credit, because carbon credit is a way to link your effort to global market. And also even EU ETS is considering to accept carbon credit. So it's going to be a big business. And in that context, I think CCS and the DAC, those two are I think, whatever scenario comes in future, those two technologies are necessary. So you can bet on that.
No, I thought just as a wrapping up point too, that really I thought the case study around Pakistan was a really good example of why precisely transition planning is so important. So that you think about these potential risks and options, and then you act ahead of time. And I think there will be many more opportunities for transition planning to play a big role.
Yeah, absolutely. Well, look, that was an incredibly rich conversation. Lots of things that were talked about that we'll go off and think further about. And I hope you are part of those conversations. It's clear to me that transition plans and transition planning are going to be a big part of the conversation in relation to how the private sector captures the opportunities of tackling climate change, but also deals with the risks, but also for policymakers as they think about how to mobilize the private sector to support these public policy objectives. And I think there are lots of different ways that transition plans can be integrated into different areas, whether that's CBAMs or export credit or procurement or public finance and so on. And we're just at the beginning of the government's thinking about how to integrate these things, and also at the beginning of seeing how the private sector is integrating these requirements as well. And Marissa and Kyung-Ah gave some really good examples of that, so that it will become a no-brainer for companies to have high-quality, credible transition plans and for those to ratchet over time. So look, a big thanks to all of you for coming. Really big thanks to the team here and the speakers as well. Join me in giving them a round of applause. Thank you.